best way that you're gonna buy a mobile home park is typically cash. I mean, that's your absolute best bet. And cash.
One of the community banks that we've worked with, I mean, they've actually expanded their reach for us, right? Because they know us, they're comfortable with us.
We know what our plan is going into a property, right? And what we're going to be able to do and be able to take out maybe seller financing in a couple of years.
And we're back on the Mobile Home Park Exchange podcast. I'm your host, Frank Rizzo. With me is my PIC, Partner in Communities, Eric Busuttil.
How's it going, everybody?
It's I'm going pretty well. Eric, how are you?
I'm doing good, Frank.
Good. I'm glad that you're doing well.
How's the fleas doing?
In this business, there are some war wounds that you get over time, and we'll obviously share that. But when you enter into some of these vacant homes that have not been occupied in a while, sometimes you can get bit, and that's all I'll say on that. Today we have a huge, I think a huge topic, especially if you're looking to buy your first community. And it's a question that you're going to be faced with it. It's, how do I finance or how do I purchase my first community and get through that first transaction? So there's a number of ways that it could get done, and I think in today's episode we're going to talk about probably the top 4 ways to do it, and talk about maybe some of the benefits and some of the challenges that you would have in doing that. And I think that's one of the important topics that we're going to have on the MHP Exchange. So Eric, and we talk about when you acquire a community, and let's say you're acquiring a community for the first time. I mean, I'll tell you the easiest way to acquire a community. Just
looking back, when we bought our first park, there was a, we looked for financing, and for somebody that's buying a park first, typically, you do what? You go to a bank, a mortgage broker, and not every mortgage broker or every bank gets involved with mobile home parks, number one. And on top of that, a lot of times, especially if you're buying a park from a person who's had the park for many years, they don't really have the best books and records. So that creates a big difficulty, especially if you're going to a broker or a lender who's not familiar with mobile home parks, right? Local banks is probably your best bet if you need financing. Local banks, a local bank in the area that you're buying the park, that is, and remember, I mean, when you're a lot of these properties that we buy anyway, they're in these smaller towns or not the largest cities, your mid markets where, a local bank, they're familiar with the property that you're buying.
And when they're familiar with the property, that will give them a level of comfortability in lending. Right? Because they will understand what the local market is. They've got a better understanding of where that property is, how it sits, how it's
the history of the property.
The history of the property, which is huge, and that's one way that you might go through that. But what are some of the challenges if you were going to go for traditional bank financing? And I talked to Eric about this because you've got, a huge...
Well, I've been doing mortgages
for 20 years.
Forever, commercial and residential. So when we first went to buy a property, I mean, that's really the first time I had any experience with buying an actual mobile home park, was when we went to go buy our first park. And I spoke to, a couple brokers that I dealt with. And, again, we ended up looking locally, and that's where we had some banks, have some interest. And again, we didn't understand totally how it worked. And there's a lot of differences when on how a bank looks at a mobile home park that's different from when somebody's going to buy your typical multifamily building.
Correct, because they are going to discount your park-owned home revenue. So your park-owned home revenue will be discounted, right? You're not going to get the full value of that. And most lenders are going to lend based off of your lot rent. and your independent lot rent. So if you have a park that has a tremendous amount of park-owned homes, and you're looking at, and then the independent lot rent, right, the tenant-owned home, those lot rents are below market. That might be the number that they spread across the entire community, and they're going to discount the park-owned homes. So that additional bump in income is almost a detriment to you because you're not going to get full value from the lender.
And just look at it like this. I mean, if you're going and you're buying a multifamily, let's say, apartment complex or building, a lender's looking at the cash flow, right? What are the income? What's the expenses, right? To the building, right? What are the rents? When you're buying a mobile home community, lenders are looking, what is the income to the land, right? And exactly what you said, Frank, you get some value for rents to the homes. Have been a big factor in how much they do take that into consideration is the age of the homes, right? If you're buying a property where the homes are very old, you're not going to get a lot of value for the homes. And the cash flow to the land, what the lot rent is, again, when you're buying these properties, a lot of times the books and records are, very wishy-washy. A lot of prior owners, they accept a lot of cash. We do all cashless. Best way you're gonna buy a mobile home park is typically cash. I mean, that's your absolute best bet. And cash.
Well, that's
6 to 12 months. You stabilize it, maybe even longer. You put your stuff on the books, and that's when you could start planning to go for traditional financing.
That's a great point, E, because if you have the cash and the wherewithal, it's a great place to invest your cash because number one, you don't have the gyrations of the stock market, right? And you have some control over where you're going to of the return that you can get. I believe and I've been in finance before, and I've been in real estate now for over 20 years. And to me, real estate is always the best investment because you can control the outcome, right? I know if I underwrite a community or if I underwrite a property that we're looking at, I can assess what the return on my capital is going to be. Not with 100% certainty, but well within a certain range where I know, $1 in, I know what my expectation of getting out, right? So cash is great. And if you have the cash, that's a super, super way to deploy it. And if you have the cash in an IRA, right? And a lot of people don't know this, they can use their IRA assets to, assist them. So if I have cash, and I say this not being a financial advisor or offering financial advice just for anybody out there, but from experience, if I have capital to deploy myself, but I don't have all the capital, but my IRA has capital, if I'm in a self-directed IRA, I could use that capital to make an investment.
Right.
Right. And that's a super easy way to do it, right? Probably the easiest.
Buying cash is definitely the easiest.
But let's look at most people, and even us. The first, you don't have the cash.
And Frank, let's not forget, if you have no experience in buying a mobile home community, I mean that's a big detriment when you go to a lender, right?
Huge.
I mean, for any commercial loan, they always want to see that you have a resume, right? What have you owned in the past? I mean, if you own a one family or a few one families, and you're trying to get into any type of commercial mortgage, it can be very difficult. And a lender may want you to hire a professional management company because you have no experience in managing a commercial property that you've purchased. And then with a mobile home park, especially if you're buying a value add mobile home park, right? Just hiring a management company won't always satisfy that non-experience. So it makes it tough. But if you are looking for financing,
and additionally, every year, if you go to a conventional bank, every year they're going to want to see your rent rolls, your book, your income statement, right? They're going to want to see that the property is performing, and most of these banks are going to want a personal guarantee.
Most of the times with any commercial mortgage that you have on any type of property, a lot of these lenders, they want to see annual financials for the guarantor, for the entity itself, any businesses associated with the entity. Most lenders do that for any type of commercial mortgage. So with a property like this, expect the same thing, right? So if you do get financing from a lender, they're going to want to see your financials annually, right? And they're going to want your financials to be in line with what your original pro forma was on that property, right? So just keep that in mind, guys. And again, back to the when you say traditional bank, Frank, there's mortgage banks, and then there's traditional local savings and loan banks. Those are really usually the banks that, again, a bank that is familiar with the property, familiar with the market.
Yes.
Where you're going to have your best.
And we've had probably our best success with the local community banks, right? We have a great relationship with a couple of lenders. And when you do, and now this was built up over time, right? So the important things is if you develop that relationship, keeping that relationship, understanding that they're willing to participate with you and making your lender or your loan officer essentially your partner in the business, having them understand what you're doing, how you're doing it, and, and not to put them out there, right? But the lender that we've been, one of the lenders that one of the community banks that we've worked with, I mean, they've actually expanded their reach for us, right? Because they know us, they're comfortable with us. We've had loans, we've paid off loans with them. And now when we go into another community, we're able to explain to them what we're doing and get an idea of what that financing package might look like, whether, like you said, on the acquisition or secondarily on the takeout. Like, hey, we're taking this community. If we do X, Y, and Z, what kind of takeout would that look? And what would the seasoning be, right? Because we've had recapitalizations inside of 6 months on some communities because we told them, here was our game plan. This is what we're going to do. Here's the income levels we're looking at. And at that point, they were willing to give us either, cost out or cost plus valuation out, right? So
and you hit it on the head. I mean, we've created a track record at a lender, and once you do that, I don't want to say it becomes easy, but it becomes easier. And we've been able to get a lender to go out of their comfort zone because they know us, right? And that's that's something that you're gonna have to do over time, right? You're not going to no bank is going to trust in you day one, right? So you're going to have to develop a relationship. And that's one of the good things about, dealing with a local community bank. And I was, going into this, me dealing with a local bank coming from New York, in my mind, I was like, all right, well, that's going to be difficult. But after going through that process, and then, living in New York and knowing what it's like to get financing on properties in New York and give financing to people on properties in New York and the difficulties there, I don't want to say a local lender is easier, but it kind of is. It's more personable. They know you. They answer your phone. They get back to you quickly. And they're more inclined to want to work with you, especially when you've done a good job with them.
But just to note, a couple of things that happen when you're dealing with these community banks, right, that you should be aware of. Because if you're looking at a broker's underwriting, right, they'll typically give you a rate that might be a little bit below what the actual rate is, right now. And they'll do it on a 30-year amortization schedule, right, or a 30-year AMO, which they'll call it. Very few community banks offer a 30-year AMO. Most of it is going to be what they call a 525 or 325 or 725 if you're lucky, right, where you can lock in that payment for a certain period of time. And then, but it's going to be based on a short amortization schedule, which you have to factor into your cash flow analysis. If you don't do that and you're basing it on a 30-year AMO, you could be surprised that, hey, wait a minute, the property's doing well, but it's not cash flowing it like I expected, and I'm not generating the income that I anticipated, right? So you have to know those terms going in, what your lender's going to be comfortable with.
And you're 100% right. Every lender, whether it's a local or a larger lender, has a parameter that they're looking to get out there. But one thing about commercial lending is there is an ability to negotiate some stuff, right? Especially the verbiage, in the documents. I mean, if you know you're going to sell a property in 2 years, I mean, if you want to fight for less of a prepayment penalty, especially if you have a relationship with a lender, I mean, we have a good relationship with a lender where we've been able to, mitigate that prepayment penalty, knowing we were going to either refinance again in a few years or sell the property. You can negotiate, right? But you definitely do have to know, what kind of parameters the lender is that you're dealing with has, because it's different wherever you go.
Which brings us to what I see, right? Because we've bought and sold properties on both sides of it. So, I think we have a good perspective on being on both sides of the table. And I see from people who contact us about maybe a community we're selling or a community that might be on the market, because we've had some exits along the way, is seller financing, right? And a lot of commercial real estate gets sold with seller financing. But I got to tell you, I've seen some really, really whacked out, offers sent in with seller financing, which kind of boggles my mind, and it makes me wonder who would even accept that.
Well, it doesn't boggle my mind. It's either someone who lacks any experience, or it's someone who just throws out ridiculous offers to everyone and cross their fingers and hope they find some Joe Schmo who's just going to be like, hey, go with it. But, yes, we've seen a lot of offers come into us for our properties that were just so ridiculous.
I've seen offers come in with seller financing of up to 90% of the purchase price.
I mean, that's never, it shouldn't, it's
and,
never gonna work.
And rates that are below competitive or comparative bank rates. So essentially, I'm hiring a manager for my community. And maybe that works, but I find that hard to see anybody who would accept that offer.
Well, Frank, let's just go back a little bit. I don't. I mean, you're, and a lot of the purchases we've bought, and for many people buying a mobile home community, if they're buying from a family that's owned the property for a long time, and their son or their grandson's got their hands on it now, and they just want to get rid of it at this point. A lot of them don't know what to do with the money.
But correct. But I don't think to take the risk, right? So if I take 10%, 15% down, and now I give you a mortgage for the rest.
Listen, forget about 10 to 15% down. But if you're making an offer on a property that their books and records aren't that great, and you can explain to the seller that, hey, I'm going to have a difficult time getting financing here. This is my plan over the next 24 months. I'll give you, 40, 50% down.
That's a different story.
I need a competitive interest rate so I could get done. And if you could get them to understand it, I mean, you could typically find some good seller financing, but you got to come up with cash.
But you have to be competitive. Right. And I see what you're saying there. Like, I've gotten a number of offers in on different properties, right? Where it's been a 30% seller hold. So they want us to hold a 30% mortgage, which sounds great. They're coming up with 70%, right? But the 30% is in a second lien position, right? So essentially they're going to get a mortgage on our equity. And then the interest rate, they're not going to pay us for 5 years. And I got to tell you, I mean, I'm out there, I make offers all the time. I don't know. I don't know if that works. I don't know anybody who's accepted that type of deal. Well, and maybe you only need one, because then it's 100% financing. But I haven't seen it.
If the terms ain't attractive, they're not attractive. But also, you want to understand what's their plan, right? It's not just about what exactly their terms are. I mean, obviously, it has to be somewhat attractive and competitive. But we know what our plan is going into a property, right? And what we're going to be able to do and be able to take out maybe seller financing in a couple of years. How are you going to get me my money? What is your plan? If I do give you, let's say we do make an agreement to give you some seller financing, what is your plan to give me my money back?
We've used seller financing multiple times, right? Because like you said, a lot of times the communities we were acquiring didn't have correct books and records. Let's take a look at Sunshine Acres particularly, right? We were not going to use seller financing on that transaction. And then what happened? We were, the owner, I mean, again, mom and pop operation, right? Great people. We had worked with them before. They told us they had about 53 residents, then, 85 lots. And then as we got closer to the closing table, we realized those 53 residents, only 28 of them were paying, right? They had a number of evictions that had to get done, right? So we took over that community at half value. We had the seller, when we sat down with them, and said, listen, I was willing to come in at this number, but now, I've lost income, right? B, now I've got to do some additional work to get people in there, which we weren't anticipating. They ended up doing a seller carry for us. But
at very competitive terms.
At very competitive terms, but for 50%, for 50% LTV, right? So we didn't go in there saying, hey, you're going to give us 80% LTV. You're going to give us 50% LTV. So we shared the risk. And I think when you're and the point of saying that is when you're presenting, I always look at it, and when we sit down talking about offers, I think you have to structure a deal that if you were on the other side of the table, you could see that could work, right? You can't, it's nice to say, Eric, we're going to find a deal, we're going to put 3% down and the seller's going to carry 97%. But that's not a reality, right? So you can go out and say, I'm going to throw out, 1,000 offers to hope I get one based off of putting up no money, which would be great. And maybe that's a model. But if you really want the deal, you have to structure a deal where it's compelling to both sides of the table. And I always find like the best deals are where people are a little bit happy and a little bit unhappy, right? That's when the deal is right.
Listen, like you said, there's no such thing as 97% financing on any of these properties. If you're going to make an offer to a seller, you need to put yourself in their shoes, and you need to ask yourself, am I making them an offer that makes sense? That if I was in their position, would I how would I feel about this offer? Right? They may be in a different situation that you are, but you don't want to insult somebody either, right? Especially when you're dealing with a good old boy possibly who's got that property for a long time. If you're going to have seller financing on a property that you're buying, you have to remember you're going to have a relationship with them for a while. So if it starts off where you're insulting someone, just remember that's always going to be in the back of their head.
I think where seller financing becomes key, right? In a negotiation is sometimes the seller has a price that they're looking for, a number that they're looking to get, but your offer is looking to be, is for it to work, it's competitively a little bit less, right? You can bridge that gap from what they want to what you want to pay by having that seller financing, right? And you can make it up in payments over a period of time, whether it's 36, 48, 60 months. And that is where I think seller financing can become very competitive for you, where you could use that as an offer. Hey, we've got a significant down payment, like you said, 40, 50%. So we have real risk in the deal. And if we don't perform, you'll be able to take the property back with this capital that we've given you. But then we can bridge that pricing gap with payments over time. So if you're willing to get a payment and you're comfortable with that, I think that's where you could use seller financing successfully. I think trying to put in offers with the seller taking a second position and a bank taking the first position, I think you're running against a hard stop, because in any seller's mind, and listen, even if the seller says yes, if he consults with an attorney, the attorney is going to say you have all the risk. If the purchaser doesn't perform, you have to take out the first lien position, and then you get the property back in a worse condition than it was, and you've never really received your profit.
I mean, you're very rarely going to see a lender give you a first position mortgage with a second position mortgage behind it anyway, Frank, in general. Unless there's a ton of equity there, and you could really make a case for why you're doing this. But, remember, you have to always go to the lender. I mean, especially if you're doing a purchase, the lender, and you're getting first position financing, the lender's going to want to know that you're getting second. And if you keep that from them and they find out about it, remember, managing the relationship with a local lender is so key.
Great point. So if you don't have the cash, you don't have the relationship with a community lender or the community bank who would lend on the property, says you just don't have the experience yet, right? We like the property. We're a little troubled with the profile of the borrower, which could happen even though you're creditworthy. You maybe you got seller financing, but you can't bridge the entire acquisition cost. Then you go to the fourth way to acquire this park, which is probably from friends and family, right? You're trustworthy. You've got some experience in real estate. You want to move forward. Now you're going to go to your network of people that you know, and you're going to say, this is what we're looking to do, or this is what I'm looking to do. And you're going to reach out to your friends and family, which, quite frankly, is how we started, right? Our first deal that we did, and we've both had successful real estate track records. I've had investors with me, on a multitude of different assets throughout my career before we really deep dived into the mobile home park business. How do you, or what were some of the things? I mean, because I know that first deal was like pulling teeth. It was the smallest raise, but it was the most challenging one that I think we ever had.
I think one of the biggest challenges for us, Frank, wasn't necessarily the product for us. It was the distance. And people knew us as one thing, right? They knew us as, local people in business. We did real estate deals. We did mortgages locally. Even though we did some business outside, this was our first project 16 hours away,
yes.
Right? And I think that was the first challenge. And on the first deal, when you go into your friends and family, I mean, just remember, they're really just putting their faith in you, right? So, I recommend starting small, right, on your first deal, because what are you trying to do with your first deal? You're trying to create what? Proof of concept, right? To make things easier for you the next time around. And in order to create proof of concept, you have to be successful, right? And especially if you're dealing with friends and family members, ultimately you want to be able to go back to them and say, hey, this is what we did together. We're on to the next one, right? And again, once you do 1, 2, 3 deals successfully, you get to know the space, you get to understand, how financing works on these things. Your acquisitions later on become easier for you to go to, lenders and local lenders to get financing.
And I think in the structure, because we have spoke with people starting out and raising money for deals before. I think in the structure, you have to respect the capital, right? So if your friends and family are putting up a majority of the money, right, or even equal to you, right, that capital has to be treated a little bit differently than your capital. And I think that's important, because then I think that ensures them of what your intentions are and where you're going with it. So whether the money flows back, right, to the return of capital first, which should be a primary function, or their money is invested with a certain rate first, like they'll call it a pref rate first. Those are things that are important, like that should be in place, rather than not treated that way. Because I think that in that respect of the capital, right, I think that's what that's what gives partners and friends regardless of the relationship, gives them the feeling that, hey, this is something that you've done, we're willing to back it, but hey, we got a pretty good return too, right? We were kind of placed a little higher than you because our faith in you was what allowed you to get to where you needed to be.
Very important. I mean, we've met with other, operators, and You'd be surprised how one operator does things different than the next. There's no exact recipe for it. Just make sure that you're clear on what your partnership is. And whatever those terms are, just make sure you're clear. And again, I mean, we do things with paperwork and the way it needs to be done. I've met many successful people do it with handshakes. Depending on what kind of partnership you have. I mean, if you have one partner or a dozen partners, it may be a little bit different.
I think you should always have everything papered up. Things change, people change. I remember the first deal I did with a very good friend of mine now, but 20 years ago. It was the first deal we did together, and we did it on a handshake. And now we're driving. So we knew each other only from business. We weren't friends at that point. And we're driving to the closing, and he turned around and he said to me, he goes, "Frank, what happens if you get hit by a bus tomorrow?" Right? Which, not that he was going to throw me in front of the bus, right? But it was...
And you were managing the property for him.
We were buying it. He was putting up the capital. I found the deal. There was a ton of equity in it. And so we were acquiring it. Quite frankly, we were acquiring it. He was putting up 100% of the equity, right? Okay. I was doing the work, right? And I was going to lead it through we were doing a flip on the property. So as we're going to the closing, his first question was, "Frank, what happens if you get hit by a bus tomorrow?" Right? How do I protect my money? So that's the question you got to ask. Not that anybody's planning for anything bad to happen, but things happen. Divorces happen, death happens, intentions change, right? You acquire a property with your friends and all of a sudden we just had a situation now where, everybody agreed, and then one person changes their mind at the end. You want to make sure everything is spelled out, laid out, paperwork is there, because the worst thing that you could do is get somebody who likes and trusts you. They're in a deal and they want to get out, and there's no way that they can get out, or intentions weren't clear, or lines weren't clear. And not only do you have a bad partner in the deal, but you've got a fractured relationship going forward. And I think when you set clear expectations and you draw everything out and everyone's agreed to, signed off, it makes things a lot easier, and it sets the expectation level. So even with friends and especially with friends and family, you want lines clear. And I think that would... running the operating the business is tough enough. The last thing you want is, a friend and family, giving you a hard time about it, because then you've got two pressures that you got to handle.
Well, listen, everybody, this was a good episode. I feel like we got a lot out to you today. Thank you very much for watching. If you have any questions or run into any issues, please feel free to reach out to us. We're at the Themhpexchange. Thank you again.
Thanks, Aggie. And we look forward to talking with you guys soon.